Welcome everybody to the crossover event of the century. All right, this is bigger. This is bigger than the Avengers Endgame. This is bigger than all those. All right, we got a Planet MicroCap Value After. I keep saying VAH. Stands for Value After Hours crossover episode with special guest Ian Cassel. I'm your host Robert Kraft. You follow me on Twitter at Bobby K Kraft, BOBBYKKRAFT, and they're all here. I told you they're gonna be. They're all here. Let's do this. So we got Toby Carlisle at the Acquires Multiple. We got Jake Taylor, Farnham Street. We got Bill Brewster. I don't even know how to introduce Bill anymore. I think he preferred just podcast host at this point. You know, that's his primary thing now.
I'm trying to win a Slashy award.
Guys, see, this is how in the know I am. I don't even know what a Slashy award is. Is it something
Model slash actor?
Yeah, I'm a podcaster / investor. Just like what was it? It was Zoolander. Was it Hansel that was an actor / model? Oh no, who? Anyway, whatever. It's from Zoolander. It was Fabio, I think, won it actually.
Wow. Actually, now I'm even more sad that I didn't even get a Zoolander reference. I should take a long look in the mirror. And then of course I really should. And then we also got Ian and we also got Ian Cassel from MicroCap Club. Ian, how are you doing today?
Doing great. Thanks for having me on.
It's great to have you. So here's the thing. Here's how we're going to really kick this off. And this is really an important topic that I know everybody watching right now is very curious about. They all are wondering, how the hell are all these books staying up on my bookshelf? This is not good. I don't know if you saw that. It's like a leaning tower of books. And it's really being weighed down by three in particular. This one in the front that no one's heard of, the Acquires Multiple. The Rebel Allocator, written by some other guy that's on this panel, and this Intelligent Fanatics project. So I don't know, guys, what should I do? Do I put a screw on, or should I just tear it down and start anew? Because any earthquake, I'm done. Like that's it. Like
I think you're short Brewster's book.
Yeah, that's real.
It's coming soon.
He hasn't finished coloring it in yet.
No, Bill he needs like at least 50 interviews, right?
Well
I think
played,
that's where we're at. We need like 50 interviews, and then it's the book. That's the game plan.
Is that how it works?
I think that's like the minimum amount.
Yeah, I mean, I think that is true. You just get everybody else to write your book for you, and then you just kind of put it together and call it your book.
You know that there's that old joke about in Australia it's two football players meet and one's just written an autobiography, and the other guy says to him, "Congratulations on your book. Who wrote it for you?" And he said, "I see you. You finished it. Who read it to you?"
Yeah,
Bobby, I'm honored you even have my book up there because usually it's used as a doorstop. I usually see it a lot. So.
Well, as I told you offline, it's because everybody read the second edition. You know, it was the first one that was just kind of getting the buzz, and then it was the second, and then it was the India version that probably sold the most. I think we can all agree.
That's exactly right. It did.
Good stuff, guys. Well, in all seriousness, the main topic that I think we all really wanted to go off of here, being that we're at a microcap show and, you know, I host a microcap podcast. We got the microcap maven himself on here right now. Is I think when we talked offline is that I think we agreed that it was all about being that we were all microcap fans and we didn't know it yet. So I mean, are we? Is that really where we're at right now? I think Ian, help us out here. Are we all microcap fans and we don't know it yet?
Well, Jake's holding himself back. I can tell he wants to pipe in, but you know, I find that most people are. You know, especially if you live and invest in a certain geography like Canada, I think 75% of their stocks are microcap by definition. So a lot of these people, they don't realize they are, but they are microcap investors. But, you know, I know just through some conversation with Bill, I know he's gravitating lower and lower into the cesspool of microcap. That's not true, but high quality names. And, you know, I know also Toby just launched or didn't launch, but take over a microcap ETF. I think the symbol's DEEP, DEEP. And I know Jake is very familiar with microcaps. I've talked to Jake a dozen times on it. I don't know if he actually owns any in his portfolio, but I know he probably understands
Jake's a microcap investor.
Yeah.
I do. I'm guilty as charged.
So there you have it. We are all microcap investors.
I was gonna say, Bill, like you recently did a great interview with Ian. And I think you posted on Twitter how you are now officially a microcap convert, or at least looking.
I don't
So
know
I
that
mean,
I said I was a convert. I said that I
I,
would be open to looking in
I was
smaller
paraphrasing.
names.
I was
I'm trying to get there by
paraphrasing.
buying a microcap and not just buying something and riding it into a microcap.
He's microcap curious.
That's right. Yeah.
Well,
No,
I mean,
I'm long some of Kyle Cerminara's companies, so I guess
gotcha.
I'm in microcap land. Easier to buy than to sell though, so we'll see how it all works out.
Well, what would you say was the thing you've learned the most, since that interview with Ian? I know me and you have talked a couple times offline. I mean, what are some of the things you learned the most that were enlightening about microcap land that you didn't know before?
I mean, look, I don't really. I guess that the thing that intrigues me the most is I think that it's probably a space that you can actually do better work than other people and get insights that sort of aren't floating around Twitter already. Or when I say Twitter, that's who I communicate with. But generally, it's I like the idea of a series of businesses that I think that maybe I can out network people about or out hustle people about or whatever. That would be the thing that I like the appeal of it. The downside is, I think Ian's point on you really have to watch how management executes, how the price reacts, and not have a long leash. I mean, I implemented that on Naked Wines, and perhaps rightly or wrongly, we'll sort of see. But I don't. That business isn't huge, and I think the price that I had paid to get in implied some growth, and I had some inventory issues that I was worried about some churn, and I had Ian's conversation ringing in my ear, and I was just like, you know what? I'm just going to get out of this. I'm not going to lose to a risk that I'm highly like. It was a key risk for me, and I started to experience it in the product. And I talked to a couple other customers that were having something similar go on. So I sort of led the data coming out. We'll see if that was the right decision or not. But I think really watching the holding and not giving it too much leash is probably where I will have the biggest struggle.
Well, I think somebody with like you, Bill, too, that understands, probably better than most businesses investing in general. I mean, I think what I said on your podcast and what I've said before is, when you start rationalizing owning something, it's usually when you should start selling it. At least that's what I've found in my experience.
Yeah, I was looking for reasons not to sell it, and what it kept coming back to is a bunch of smart people that I know are long it, and I was like, I can't look myself in the mirror and lose to that, right? So I think generally the thing about that name is it's a little bit more liquid. So being choosy about what names you get into, and then understanding that it's going to take a while to get out. That's not a world that I'm used to operating in.
Are you in long-term capital gains in Naked Wines?
No, man, that was only like a couple months, but I mean,
Has it run a lot?
no, it didn't. I think I made like 14% or something, but it wasn't even about what I was up or down. It was about like I had a fundamental thesis that I thought that the pandemic offered that company a unique opportunity to acquire customers. But in that kind of business, you got to serve the customers that you acquire correctly. And I was worried. I mean, my wife and I were opening bottles of wine. So for people that don't know, I like it because it's a risk-free offering. If you don't like the wine that you're drinking, you can literally pour it down the drain and write to them and say, I want my money back. Well, that's all well and good until you have house guests over and 3 bottles of wine taste like crap. And your wife says, please don't open another one of those bottles. It's getting embarrassing. And, like once it's that, the problem, if my experience is representative of reality, and I have had people reach out that say like the quality just isn't there, what is your greatest asset in the pandemic driving customers can also end up in like I think of it like catastrophic success, right? Because if you're not prepared to make those customers happy, then you form like it. I just think the potential that people are forming a negative opinion is much higher than I thought when I got in it, and that fear drifted over 3 months because they got tighter and tighter on inventory, and I felt like the quality decreased. So I'm not going to lose to that risk in that entity.
Is that specific to them, or is that, it's just anecdotally? I've noticed there's a lot of stuff that
I was thinking the same thing.
just there's no inventory for lots of different things that I regularly get that they're just not there anymore. Haven't been for months.
Yeah, I guess like with that particular entity, and I like that entity, and I like the guys that are along it. So I'm not trying to like talk negatively on it, but what makes me worried is that was solving something in my life that I really believed in the value proposition, and what it did was open the door for the local liquor store to serve me wine that had inventory, right? So it's just like I don't know. I don't that business I thought was very habitual, and I don't think it's easy to rebrand a bad experience in customers' minds. And I don't think that I was paying like a super cheap price. So I think it's got to grow into what I paid, and I think that little growth, the certainty that I had when I underwrote the growth changed, and I just wasn't going to stick around. But maybe that's because I got like a quick trigger now.
What are they selling that's different from everybody else? What's their offering?
I mean, they are the actual winery, so they can ship direct to consumer. And what they basically do is it's like white label wine, where, you know, they'll go out and contract with a grower. The grower will grow on their premises, you know, so like they lease the land, they help the grower obtain the grapes, and then they are able to ship to you. So one thing that's really awesome in Florida, it varies state by state, but I could order wine on Wednesday night and get it on Friday. And the average winery needs to charge a lot per bottle. I mean, I think it's like somewhere between $7 and $9 a bottle to ship. And Naked can do it for like 3 to 5 because they have the scale. And, you know, I kind of, there's the part of me that likes the idea of, you know, convenience and e-commerce and shipping alcohol to your door. I mean, that's sort of the way the world like should work to me, but I'm not sure. I hope it does work that way. Like I said, I know a lot of people.
You can only buy their wine, but if you can get some other wine shipped, why can't you just choose the wine that you want and get that shipped to you? That's
They have a bunch.
A regulatory issue.
Yeah, the 3-tier system in the U.S. doesn't allow like just any wine. I mean, a small winery can ship to you, right? But they don't have the scale to do the shipping. And if you talk to different wineries, it is a major pain to comply with every state's regulation. So it's like much harder in practice than it may seem. So most wine is distributed through a distributor that then goes to retail.
I mean, not to focus on the company again, but because we're based in California, you know, me, Toby, and Jake, and you know, like I know my parents had a wine subscription to some of the local wineries from Napa and Sonoma and stuff like that. I mean, you can't get those wines as part of this subscription. It's only the white label stuff from wherever they're producing the wines right now, or that's how it works.
Yeah, that's correct. And then what they do is the whole thesis is since they're selling direct to consumer, they're trying to cut out the middleman. And there's a lot of margin in wine that they're trying to cut out and sort of give the benefit to the consumer. I guess where I'm somewhat concerned and where I got concerned is a couple of the bottles that my wife was like, this is getting embarrassing, were, you know, north of $25. And that's actually where they say their greatest value proposition is. So it just, you know, I don't know. I don't, if it's Disney and they have a snag for a quarter, that doesn't really matter that much to me. When it's Naked and I perceive them to be having a snag when they're introduced to a bunch of customers, and I'm like, I was at my friend's house and I said, hey, you should try this. And she's like, I tried that. The wine's not that good. Like, that's a hard consumer perception to redo if you mess that up. And I'm just worried that they may be in a forced position of messing it up to the biggest amount of customers they've ever seen. So I don't want to sit around with it. And it went back to Ian's conversation with me when I was just like, okay, this is smaller, so it's inherently a little bit more fragile. So watch it more carefully.
Yeah.
So speaking about that, maybe it'd be interesting. One of the questions that I wanted to posit to you guys was the this idea that's especially come on in the last 20 years, but maybe even more so in the last 5, of returns on scale. And that, the bigger the business, some of the returns have been even better due to the network effects and, different economic characteristics. How do you square microcap with that, kind of David versus Goliath? If Goliath is the one who's winning and has the resources to keep winning in the new kind of digital world, why would you bet on David then?
This is a perfect question for Ian.
Thank you, Bobby. No, I think it is a great question, and we talked about this a little bit previously. When you can look at something like Amazon, look at something even like Target that was up 100% last year, I believe, or Apple was up 100%. I mean, it's mind-boggling to think the largest companies in the world, which are mostly technology companies, are still growing at 30% CAGRs. And now I'm supposed to take on this a bunch of risk investing in smaller companies that are also growing at 30% CAGRs. Like, why would I bother doing that? And I think it's the right question to ask. And I think we've been in, Toby would probably give some good analysis of this, but I mean, I think we've been in this trend of high tech growth for a long, long time, but I still believe you can find these undiscovered companies that are just undiscovered. And, one of the points I'd like to make too, and this probably gets back to your point as well, Jake, is just because a company is illiquid and unknown and undiscovered doesn't mean it's undervalued. And I find that quite often. I'll find a stock that I really like that trades 1,000 shares a day, maybe like $5,000 worth a day. And I'm like, oh wow, nobody knows about this. But you look at the valuation, you're like, okay, it's not really cheap. And so you find that quite a bit. And even in microcap, I think probably one of the misperceptions is thinking that it's just a bunch of idiots that are investing down here. I mean, there's a lot of smart investors that are investing down in the small microcap arena. The demographic is getting younger and younger and younger and smarter and smarter and smarter. Back, 15 years ago, I remember going to a microcap conference, probably in 2004, 2005. I would go to an event, there'd be 60 people there, and I would be by far the youngest person in that room. The average age was probably 75. It's like they just let out the local retirement center and said there was a free lunch, come on in. It's like what it looked like. There was very few younger people there. And now when you go to Bobby's event or you go to another event, I would say the average age feels like it's 30, or less. And, you could say that's partly the function of a 10-year bull market, people wanting to take on extra risk, not knowing or understanding the risk they're taking. But I also think that it's probably just quite honestly, I mean, microcap's been beaten up for a lot of years and even a decade or two. That's just getting revitalized now. So that's a roundabout. I mentioned a lot of things there. None of them answered your question, Jake. But I just think for some of us that like looking at those small undiscovered companies, they're still out there. I have as many feelers out there looking at ideas as anybody with Microcap Club and also just personal networks. And there's still 5 or 6 companies I stumble upon a year and think, wow, where was that thing been at? I thought I looked at everything. And part of that is, maybe half of those are here in North America and the other half is just starting to look abroad in Australia and the UK and other countries. But I mean, it's just a phenomenal opportunity when you think that half the publicly traded companies that are out there are small ones that 99% of the professional financial universe has never heard of. And that's the opportunity that's down here.
Ian, can I ask you a question? Because it's been, you've sort of alluded to it earlier, but there's been this long period now, maybe 10 years at least, of small and micro really getting beaten up relative to the rest of the market, to the point that the size factor, high minus small minus large, is now sort of, well, there was some suggestion like 6 months ago that it was basically one of those factors that we had to throw on the trash pile. It sort of seems to have come roaring back really recently over the last maybe 6 months, maybe 3 months, something like that. What do you think helped you? Your experience was clearly you've done really well in small and micro cap for that entire period. Why is your experience so different from the index?
That's a good question. I think, if you look at the last 3 months, quite honestly, you see a lot of trash that's flying. I think there's been some research done. You might even have it, Toby, where, if the unprofitable microcaps are outperforming the profitable ones by 3-to-1 margin in the last 3 months or something like that. And so that's just it's one of these oddities that's happening. And just, I think Robinhood has propelled microcap in general, for the listed microcaps that are out there, just increasing the amount of liquidity we see in some of these microcap names is unreal. And some of that's going to result in bad outcomes, but one of the positive outcomes is it's increasing the volume and liquidity profiles enough to where investment banks and research institutions can now be profitable, starting to cover these companies again for the first time in 20 years. And so you're seeing a lot more financings being done down in the small and microcap arena because those liquidity profiles have increased enough to where it makes makes sense for them to have research coverage and a banking department devoted to them again, which we haven't seen since the mid 90s. So, it's interesting. The last 3 months, 4 months, I've felt it. I felt like there's just been a lot of trash that's going up, but there's also the positive part of that where it is, I think, a net positive probably for microcap because of that. You kind of have to take the good with the bad with some of these things.
Coincidentally, it's the best performance for my strategy in about 10 years, the last 3 months.
Yeah.
which is really funny because I don't think that I'm a trash investor. I think that I'm a quality investor, inside the value world. I'm not disputing your characterization at all. Because the rally, lots of people have said it, but the rally has been characterized by small, cheap, which is value, and junk, which is, the inverse of quality.
Is that why you took your shirt off on Twitter?
That was actually my other main question to ask. Was that why
funny.
the shirtless Twitter photo?
Well, what is up with people taking their shirts off on Twitter? Like, the bigger your account, the more likely you are to take your shirt off. Just so people listening at home don't think that I took my shirt off. I cut my head off and posted on somebody else who put their torso on Twitter. Mostly because that bloke's a lot fitter than I am. I wouldn't put my own up like that.
I showed my belly button once, and I'll never do it again. It was disgusting. I'm sorry to all my followers.
On Twitter?
I have to live with it, so you had to see it for a day.
Did you delete that tweet?
No, I kept that up. It was after Skinny Legs posted his, so I had to show him mine. Anyway, I digress.
Wait, Toby, I wanted to, you just said that, this has been the best performing few months for your strategy. I mean, have you been able to deduce why that you've been seeing that as well?
Right, first, let me interrupt. Toby,
okay, go.
You now run a microcap ETF. I believe
Yep.
the symbol's DEEP, DEEP.
Yep.
When did that happen? I know that's been somewhat new opportunity for you. Give us the background on that.
Yeah, because I run a big one as well, ZIG, which is mid cap and above, and it's long short. And I watched the competitors in that space, and one of them was DVP, which was the Tiedemann Wealth, the Deep Value Fund, and they decided that they didn't want to run it anymore, I think, and they sort of handed back the keys to the white label provider. And I was interested in running it, but I didn't want to run it as a large cap strategy because I've already got a large cap strategy. But I could see that small and micro was so beaten up, and it's been like, in my back test data, it's been literally a decade of going backwards. And so that was one of the challenges, was getting it through the board of the trust, showing them that it's not endemic to this strategy, or it's not a characteristic of this strategy that just loses money all the time. And I was trying to show them it was sort of unusual, but it was a big bet, and I'm glad they kind of let us put it on, because I thought that the portfolio was, when I was looking at the portfolio, the construction of the portfolios, and I started saying this at the end of last year, I was calling it the big long, but the portfolios looked to me like they literally needed no multiple expansion. This is the small and micro portfolios, needed no multiple expansion to start outperforming, because the yield was so big. The yield at that stage was like 6%. And the reinvestment growth, I thought, was going to be very big as well, not really knowing how much. And since we got it changed over on October 26th, since then it's run really hard. It's run up a lot. But it's
Bottom ticked, basically, the underperformance.
Yeah, how much was that skill there?
It's 100% skill, 100% skill. No, it was 100% luck. It was just, and I'd been like, if I'd had my way and it had got through the first board meeting, then it would have been 3 months earlier. So we would have had 3 months of bad performance. But as it happens, we got we were unable to do it in the first board meeting, got it through the second board meeting 3 months later, which meant that we managed to tick it like literally the day that it turned over was probably the bottom for that strategy, and it's rocketed since then. But
I think it's a great product because I think it's easier for the average person to hold that than to hold the underlying within it. Because when I go through and I look what's inside of it, it's like, oh boy, let's I might need to start taking antacids or something to hold some of these names. But then as the whole strategy though, it like makes a ton of sense.
And that's a common feature of the stuff that I run. And that's why I've written the books, because I've been trying to explain that these things are optically, like you just don't get to buy them. There's never a good time to buy them. When you buy them, they always look really ugly. You're sort of relying on the extreme undervaluation and the downswing in the business cycle, that when the cycle changes back up again, they're going to look a little bit better. But in the time that we're going to hold them, and this is why I talk about quality too. I prefer cash on the balance sheet, cash flows, and ideally I want them buying back stock. And when I can pull up the Morningstar does this thing where they call it style measures, but they'll look through your portfolio and compare it to the index. So on every value measure, like price earnings, price to book, price to sales, price to cash flows, deep is cheaper. It's got a higher dividend yield, and then all of the growth measures are higher than the index and the average in the category. And the reason is that, we do have this extreme value bias, and we also look for very high quality within that kind of value universe. So it doesn't surprise me that the portfolios look like that. The problem is that the portfolios also looked really good last year, and they underperformed. So it's not just how the portfolio looks, even though, I think that ultimately over time that should win out. It's just, it takes, the cycles in this business are long, and I think my hat's off to people who've survived in small and micro for a long time, because it's been tough. Now I think you got a tailwind. So it could be a tailwind for a decade.
I have a dumb question for you, Toby. So you run 2 ETFs now, and when I think about maybe somebody like Jake or somebody like I that have either SMA or LP structures, when you're talking to new investors, you're talking to new investors because you have to onboard them, they have to fill out subscription agreements, blah blah blah. But obviously ETFs, it's a lot less friction, and so I'm curious on something like that with those two, like how much of your time is spent actually talking to new investors? Do you talk to new investors regularly that are interested, or do you know like 50% of the people you think that make up the balance of the funds that are in it? Like, I'm just curious how you think about that.
Yeah, it's hard to know. So Deep had got a nice write up in Bloomberg where they're not saying that it is the next ARK, which is the very big ETF out there. They're just saying that this is a counter strategy to ARK. Like I basically trade inversely correlated to ARK. It's bizarre. And I get it with Zig, because Zig's short some of the ARK longs, but Deep is not. Deep's sort of its own universe of stocks. It's completely different, but it trades inversely. So if anybody's got a whole lot of ARK exposure, you could hedge it with some Deep exposure. I'm just kidding. That won't actually work. But I get people asking regularly, to explain what's in there, and I see the flows from something like a Bloomberg article, but not really. I don't know necessarily who's coming in or who's going out. So I assume that because my partner's in that around till, and they've got quite a young universe of people who are invested in stuff. Like they've got other ETFs that are sports betting one, and a gaming and entertainment, like a computer gaming and entertainment ETF. And so I think that they're younger people who they look at something like Deep and they're just like, what is this thing doing here? But maybe, because it's round till, they give me that, it gets some flows for that reason. So I don't know necessarily who's in there.
It's definitely not the pod, no, it's definitely not the pod. It has nothing, no credit.
The podcast.
There. Yeah.
Well, that's helpful because at least people sort of see us chatting regularly.
Yeah.
And know kind of how I'm thinking at any point in time. But having said that, the strategy is still pretty, the strategy is systematic. So there's not a lot of input that I have one way or the other. So how I'm feeling on any given day is really irrelevant. I'm sort of discussing more globally what I think the prospects of it are. So, the dividend has come in, the dividend yield on that fund's come in from 6% to I think it's a little bit over 4% at the moment. But that's, you can take the inverse of that, and that's the run in the price. So to me, that says that the value has started working. But whenever you get the run like that, the forward returns go down.
Very good. So, I mean, do we want to cover anything else? Or I got a couple questions in from Twitter that people wanted us to cover on here. So I could either go there, or did anybody have any other questions about Deep, or whether the bookshelf is still holding up? Or I mean, should I go there?
Questions we can take.
I have one that I thought about beforehand. Okay.
Go for it, Jake.
I think one of the cool things about the micro space is that the CEO will take your call often, right? Like if I tried to call Tim Cook, he's not having it, right? But, if I'm in a smaller name, you could talk to them, maybe get to know them a little bit. Now, is that a good thing or a bad thing? One of the things I'm always worried about is the halo effect of management, and you don't get to be the CEO unless you know how to sell a little bit. What do you guys think about that?
That's another 2 hours right there. But Ian, go.
That is.
Ian or Bill. Ian,
2
Bill,
minutes
Bill.
or less. Go.
I don't know if for me, I've gone back and forth on that like a pendulum. I would say, if you were talking to me 10 years ago, I would have said it is a CEO of a small microcap company's fiduciary duty to let more people know about their stock today than knew about it yesterday, or else why are they public? Where then, and probably maybe William Thorndike and the Outsiders in 2012 kind of shine some light on that, where you have these folks that were great capital allocators that didn't care about IR that performed really well. Then I kind of pivoted to the other side or the other extreme of that. And kind of where I end up today is kind of somewhere in the middle. And I think for me, it just comes back more and more the older I get about just execution. You're always going to find a CEO that's more talkative than another one, some that don't talk to you, some that do talk to you, but it just I try to let their execution lead in my decisions. And it's funny, having written a book on intelligent fanatics, probably one of my biggest takeaways from that book was actually paying more attention to the people around the intelligent fanatic than the person themselves. And so that's a big part of where my diligence has changed, is actually probably spending less time with the CEO, with him or her that's running the company, and more so about the types of folks that they surround themselves with. And, even when I look at kind of how I've evolved over the years, it seems like, at least for me, there's always like these 2 or 3 or 5 year swaths where I'm probably weighting something more than I should. And there was probably 5 years where I weighted the CEO more than I should. And even more so almost in execution, because I just liked his qualitative characteristics of that individual, and then you might weight something else, valuation more than you should. Like, this needs to be, the cheapest thing I can find, or whatever it is. And I find, like, over the last 20 years, I've kind of overweighted things and then kind of get back to the reversion to the mean of where I should be, overweight some things, learned more about this, kind of brought back. And now it's kind of just a stew, if you will, where I just try to weight everything equally, but the overrunning theme is just execution.
When you say execution, sorry, are you looking to see, are they doing what?
Yeah, it's just simple, doing what they
said
say
they were going to do.
Yeah.
Have you noticed that phenomena, like in the Outsiders, where a good possible cap allocator almost always has a really strong number 2 who's operationally minded and kind of blocking and tackling in the business?
A lot of them do, but not always. I do like, I mean, usually there is that, that person that's a little bit less spoken, that's kind of the numbers person behind the scenes. A lot of times you do see that. It's nice to see that kind of pair or team part with the microcap.
Just like, oh, sorry, Bill. Go.
No, I was just gonna say, like, probably the most recent microcap big win that I've been, fortunate to watch. I haven't participated, so I don't know how fortunate I am, but has been my buddy Mike Mitchell, and he called up, he saw liquidation opportunity and called. I mean, it was Kyle Sermonara on the phone, right? And then they start talking, and then he starts to understand how this guy thinks, and then he's like, all right, I like how this guy thinks, and then he looks into it a little bit. And I do think that, for me, when I was diligencing that sort of complex of companies, I mean, I called anyone that would reach out to me that said that they knew him, didn't like his partner, liked his partner, like anything. I do like the ability to check the character of people. Now, maybe that's because we have a podcast and I have a little bit more access to people that want to talk. But I don't know. I feel like the people part, at least, I mean, I have not been in this space long enough to know anything, right? But to me, the people part in this area of the world is very, very important. And I would need to talk to a CEO in order to get involved with the company. I don't think that I could get involved with a really small company without talking to management.
I agree. I didn't mean to undermine too much this speaking to management. I still talk to every CEO I talk to and at least 3 or 4 people around them. I would just, I think 10 years ago, I was going down to, like, I was talking to people they went to high school with and stuff like that. That might take a little bit too far, but
yeah. Well, I get
but,
it, because you want to know the character.
No, exactly. I mean, the smaller these companies are, the more important management becomes. And especially when you get down in the super small stuff, sub 50 million, a lot of times it is just a one-person shop. And the bet you're making is that they can grow it. And hopefully they have the wherewithal to build a team around them as they grow it, and build in those processes, those feedback loops, so they can scale quality with scaling of the business, kind of what we talked about with your circumstance, Bill.
So let me throw a question to you guys, because I don't meet with management. I don't really like to do it, because I like charismatic folks and I'm always persuaded by what they have to say. But to the extent that I kind of listen to what they're saying, I always think I'm listening for something that some sort of trick to understanding what they're doing, or some sort of idea to get where they're going, and trying to ignore all the stuff that I really like about them. Do you guys have any sort of view on whether it's actually helped your results to talk to these guys, whether it does actually help you, and in what way? Like, no, I think this guy's got great character. How can you assess someone who doesn't have great character from a conversation?
Well, I mean, Buffett's changed my life, and I listen to everything he says. I find it really, really funny when value investors are like, I don't want to talk to management, but I'll go sit in Omaha and recite everything that Buffett says. Like, you're talking to management. You may not be talking. He might be talking to you, but like, I find it confounding that value investors say, I don't want to talk to management, and then they listen to Buffett nonstop.
But Buffett's telling you, the reason is that Buffett's giving you the guide, whereas management's giving you, I'm not talking to him because I want to know, I'm not listening to him because I want to know about Berkshire. I'm listening to him because I want to know about investing.
I guess.
I
don't know that I agree with that. You might, that may be for you. I'm not sure that I agree with that for me or for most people.
For me, Toby, I know me and the consistency of talking to the CEOs that I talk to, which is fairly consistent. It's less about confirming my conviction. It's more about watching out for the downside, seeing how just tone variances change in their voice, how they talk about different parts of the business. That has saved me more on the downside and that's worth more to me than even the upside, because I kind of know the bull thesis, and the conviction of it. It's more about protecting my downside.
Yeah, I think it's possibly a good negative indicator potentially, and a deal breaker, not necessarily a deal maker. If you picked up on something where you're like, it just gives me a bad feeling. I mean, we've evolved to detect insincerity in people, right? Like, that's something we're very good at. It might actually explain why we have so much intelligence, was through managing social dynamics and relationships. So we're wired to kind of sniff out BS. And if you start to, smell it, there's probably maybe something behind that. And it pays to probably listen to that. And maybe, obviously you can be sold pretty easily, but figuring out if the horse has a broken leg before the race starts is often a pretty good thing to know, even if it doesn't factor into your model necessarily.
What about, sorry.
Go ahead, Toby.
I was just like, how does, not that say Valiant, and I realize this is not a large cap, this is not a small cap stock, but Valiant, was like, for a period of time there, it was just everybody had a position in Valiant, had a big position in Valiant, and they're all looking at each other saying, well, Sequoia's got a big position, and I don't want to name anybody else who I can't remember who else had it, but there, it felt for a while like every big value investor had a position in Valiant. And I looked at it a few times and I just didn't get it, and I didn't ever have one in there, and that felt dumb for a while, and that felt smart for a while after that. So I just, what is it that allows these guys? We're all good at assessing. So as far as we know, the character of someone. What is it that allows something like a Valiant to sneak through?
Well, I think just like everybody likes to point to Amazon as a 2000 bagger or whatever it is at this point, you're always going to have those outliers on the downside, like a Valiant as well. And just because Valiant lost a lot of people money, a lot of people made money too. And I think probably the biggest takeaway relating that to microcap is, a lot of these companies that I own, a lot of the companies I own today in the portfolio, I'm not going to be holding forever. Something's going to change where I'm going to be selling them. I know it. It's just what my history says, and not, and you're always going to have an outlier event. I had two of them in my career too, where something really negative came out. One of them happened in like 2011. It was like about 30% of my portfolio. They halted the stock because the auditor said they couldn't find the cash that was supposedly on the balance sheet. And
did it turn up?
Again, I look back.
It was in the couch cushions.
Yeah, it did not turn up, but it ended up taking a loss on that. It's one of those you always look back, well, should I have done this or that or the other thing? And you're always going to have these outlier events on the negative side. And everybody likes to beat up Sequoia for letting it run up to whatever 15% of their portfolio, and then they took a hit on it, which was probably still more money than they invested in it originally. But you're always going to have those types of events that come out. You learn what you can, and then you don't beat yourself up over it any more than that. At least that's how I view it.
I mean, Naked's a good example of that right now, right? That it's almost universally, anybody who's I've seen it discussed as a consensus long on Twitter for a long time, more than 6 months, a year maybe. And I forget who it is, but one of the guys who invests very rarely has a position in it. So that's sort of the thing that Bill, do you know who I'm
Norbert
talking?
Lou.
Is it Norbert Lou?
Yeah, but he bought it at like $2, so it's a completely different bet. Right. No, I mean, he bought it at like a $200 million valuation. Now it's closer to 700. So slightly.
What company
different.
was that? I didn't hear.
It's Naked Wines.
Naked Wines. All right. Yeah.
For the qualitative setup that I like to find, and obviously I'm more of a growth investor, but the types of people that I like to find, the leaders that manage them have had previous success. I love to find a founder of a company that had a 50, 100, 150 million dollar type of payout on a previous business, and now he's backstopping his own vision with this new opportunity. And there's not many of them, but you can find one of them a year where you're like, whoa, this guy just put in $10 million of his own capital, and he's backstopping a great management team, and he doesn't need to listen to the investment bankers that are going to be calling him up every day, or everybody else that's going to be, he's just going for it. And those are the folks, it's kind of like those little qualitative things I look for that over the years I realized, 80% of the time, that's something you should take a serious look at, those types of people.
Yeah, well, they got something in them that keeps them going, right?
Mm-hmm.
That a lot of people would just hit the eject button and say, I'm done.
Hey, Ian, the two things that came to mind based on Jake's question when you asked about, whether it can be a good thing or a bad thing. And, I think back to all the interviews I've done with management teams, as well as, all the interviews I'm sure you've done and hosting 2 events and hearing all the presentations and everything. But I'd say the two things that stand out to my mind that I always kind of listen for just out of interest. And usually when I look back and see if I've interviewed them again or how the company's performed, it's when a company says that they are addressing a TAM that's in the multiple billions to, tens of billions, just a ridiculous number that just doesn't make sense, especially considering where they're currently at. And then on the positive side, probably the number one thing I love hearing the most, whether it results in any kind of good performance or not, I just appreciate it the most. And I actually heard it for the first time when I was at one of your events, sitting in one of the group sessions, is when the CEO told you the bear case, just flat out, here's why our company will fail. I mean, in your experience, some of the companies that you've looked at, have those two things come up a lot, or has there been any other things in speaking with management that you're like, okay, this is a good reason why to talk to management, because you can get some of this information?
Yeah, and it's funny you mentioned that. You probably have interviewed more management teams than anybody on this call, or most people that are out there. I mean, I wonder how many people you've interviewed over the years.
It's in the
Thousands,
thousands
probably.
thousands range now.
It would be interesting if you were able to kind of benchmark and kind of write down things as you're interviewing them to see which ones actually worked out or didn't, but anyway, but I digress. But I think it might be more of a personal thing. I'm like you, like I hate hearing companies say they're going to, try to get 1% of $1 trillion market. I could really care less about the TAM. In fact, I love small TAMs. It means, I love when they dominate a small market because it means when a company dominates a small market, and it's a microcap, obviously it's a small market, but it really vets management because they either took the market by taking the market or they created the market. Neither way, it shows they're competent. And I love that as kind of a qualitative attribute. And that's what I look for as well. But I'm with you on that.
Sounds good. All right. Well, I think we got about like 10, 15 minutes left. So I'm going to get to our Twitter questions. And this one actually ties in perfectly because it was the first question submitted. And it was from @LizSimi. She was featured both on Planet MicroCap and also on Bill Brewster's pod. And she's quite incredible in all the work she's doing on ESG. And so I guess trying to relate ESG to microcap investing. And, for me, the most important thing I'd argue, at least, especially in microcap, because this is something that they can have control over, is the G, governance, And so let's just say in general, ESG, microcaps, what is everyone's thought there? I mean, is it possible to implement an ESG strategy successfully, both from the company level and on the investor level in microcaps? Anybody? Just jump right on in with this one.
I'm not an ESG investor, but I have recently talked to some folks who are. Anytime you add a limiting factor to a universe, you're likely to your performance is going to deviate from the universe. And to the extent that the E and the S cause you to deviate, I think they tend to cause you to deviate below the index performance. The G might be like a quality metric, but the G is sort of hard to implement in the sense that the way that we like to implement it in making these assessments is often with a box checking exercise. Whereas I think, the G, to the extent that it's a quality metric, should be manifesting in the financial statements as, get better governance should manifest in better results, or it should, it just eliminates the possibility of self-dealing and all, overpayment, too much compensation, all that sort of stuff. So I think that there should be more focus on the G. It probably deals with some of your issues on the E and the S side as well. Because I do think that companies should recognize other stakeholders for a variety of reasons. One, because it increases their risk to not appropriately recognize stakeholders who can be injured by the company. And so I think that the G is much more important, and I think the G gets almost no attention. And I think that if you get the G right, then you probably get the E and the S right too. But typically when you add a limiting factor, it leads to underperformance.
Yeah, I would add that I don't like the fragility of having rules across all companies, like we kind of start to see with ISS and Glass. If we're all doing it all the exact same way, right, that creates a fragile environment, and that's how like problems can sneak in. Whereas if we have a more diversity in the how G is executed, we can get more emergent behavior of best practices and what works and what doesn't as the environment changes. I kind of also feel like the E and the S are a bit of a bull market luxury. And if it's about returns, or is it now you want returns and you want to feel good while you're getting them? Sometimes the game is hard enough without getting all the extra stuff along with the good return. So I don't want to disparage it, because I think I think business in general can have a huge positive impact for society. And I want people to think about that. And I like stakeholderism in general. And to your point, Toby, about the paying attention to all stakeholders that a business interacts with, I think is hugely important. And that's been around forever if you had the long-term mindset, right? Like there's nothing new about that. If you had been thinking about the long-term sustainability of the business, every good board that thought about the 30-year picture was worried about, I can't have my company trashing the environment. That's going to come back on us, right? So anyway, I think it's good marketing. I think it's it's sort of a mixed bag for me, I guess.
I think I guess as Liz frames it, it makes a lot of sense to me to look for companies that have all different types of people on, within the company that are, forcing it to think in a diversified manner. I mean, I do understand the merit in that. I don't have it as a limiting factor on what I will or won't invest in, though. But I can understand why, her framework arguably creates sort of a more anti-fragile subset of companies to pick from. But it's not, you're not going to hear me running an ESG fund anytime soon.
Yeah, and just to hit on what you said, Bobby, in the beginning, I think you were right. The governance part is probably the at least from what I think is one of the more least talked about but important parts of micro and small cap investing. And I know the folks over at Small Cap Institute, which is Adam Epstein and David Scher, they're going to be coming out with a couple courses on really kind of educating investors on what does a good corporate board even look like. Because there's a reason why some of the largest funds in the world spend hundreds of millions of dollars on corporate governance, making sure that their companies have proper corporate governance and all those things. And obviously the types of things that they look for or put in place aren't exactly, it doesn't make sense for a company that does 5 million in revenue and they can't add on those types of procedures. But there's some simple things that I think investors can look for in the types of boards that they're investing in with companies. And boards are really important. I think we've all invested in companies where it was just the CEO and a bunch of guys or gals from their country club, and you want the board to be a value add, to that company.
Yep. So. Agreed. Okay, last question before I let everybody go. And this is a what if scenario. It was submitted by Paul Higgins at Paul H4224. Thank you, Paul. Assume you were banned from investing in stocks overnight. You had 10 years runway and startup capital wasn't an issue. What industry would you disrupt, or what startup would you go all in on, and why? By the way, this is going to be my Bill Simmons moment this is going to be the social clip. This is what we should social clip later. But anyways, I leave it to y'all. What would you do? Who wants to go first? So whoever's going to go first, that they've been thinking about this the most. So that's the catch-all question, right? So I think, let's see, who wants to go first on this one?
I'll go last then.
Yeah, I'll go after Jake.
I mean, you're asking what industry would you disrupt and why?
Pretty much, yeah. What industry?
I mean,
would you disrupt?
I'd either attack healthcare or education because I think they're the biggest grifts on society.
I agree. Healthcare in particular. I was
for sure.
I watched this interesting talk about what Singapore does for their healthcare system. And it's basically like a super high deductible plan that give people money to spend on their typical healthcare expenses. And then there's a competition for the service. So, like you actually shop around a little bit. You make sure that the doctor is the one that you want instead of just showing up. And it's not an all you can eat like we do here, with especially with Medicare. You just consume and consume. And so we're at like 18% of GDP in frictional cost of keeping everyone healthy. And other places we're down at like, sub 5% and similar qualities of care. I mean, what a deadweight loss for society in general. Like, I think it's such a misallocation of resources by having a bad system with bad incentives. So if I could wave my magic wand and and have, I don't know if I want to do it, but if I could have one industry that would suddenly get shaken up overnight, it would be healthcare.
Ian, Toby?
I'll piggyback on that. I agree. I mean, it just seems like that's where I'm invested right now too. I think probably half my portfolio is in kind of med tech type areas where they're trying to make a difference in those areas, and something where I find myself kind of holistically looking toward, as well as you still have microcaps that are what I believe are truly changing the world as small microcap companies in those areas that happen to be small microcap companies where you can find high organic growth rates, have moats, have great management teams. Just an area that I've been focused on recently. So I agree.
Yeah, it's hard. I have ideas for things that I want to do subsequent to the things that I'm currently doing, so I don't really want to discuss them too much. And I can't think of anything else off the top of my head.
Would you disrupt value investing with an ETF?
See, I think that the strategies that I have are appropriate for an ETF, and that it's a way for sort of transforming what is, I probably trade a little bit more than like what a traditional value investor does, because I'm a little bit more quantitative. But I would change the structure to do a slightly different strategy. I want to do a buy and hold for basically forever as the next thing that I do. And so I've been looking at different ways of implementing that. I don't know if this is enough outside of I don't know if this answers the question, but I think that there are more appropriate structures for that kind of strategy. But that's sort of the thing that I want to do next, because I think that there's some interesting phenomena that occur when you buy something and hold it for an extremely long. You just keep on holding, and I don't know if it's a bull market, if it's something that only looks good at the very top of a bull market, or if it's something that can survive a drawdown. So I just want to see what it looks like on the other side of a drawdown.
Jake is agreeing with you, I see.
Yeah.
Yeah.
My 2 cents, it would be actually not just education, but financial and education specifically. I think that probably is at least for me, the next generation needs a lot more tools, whether it's a tech answer or just a better infrastructure answer. I'm not totally sure what it is, but just better tools for K through 12.
I can't believe that someone hasn't
Coin
created
solves this.
Few understand this.
Yeah.
I don't understand why someone hasn't just put up, this is the standard K through 12 education on YouTube. If your kid can go through and watch every single one of these videos and answer every single one of these like radio button exams on this HTML website that we have over here, they can pass through to grade 12. I can't believe that doesn't exist. Maybe it does already exist. Maybe that's what Khan Academy is, but that seems to me like an obvious, put it out there for free. Do it like MIT has stuck all of its courses out there for free.
Like Value After Hours does.
Planet MicroCap. Don't worry. The premium option is coming, y'all. It just, in 10 years, the premium option will eventually be there. But with that, I think we're about there. I mean, is there anything we've missed today that's a current event or something that we needed to cover, or what do you think? I think we covered it all.
I'm reading a good book. I don't know if any of you guys have read it.
Ooh, yeah.
It's called The Emotionally Intelligent Investor. You guys ever hear of this one?
No, but I like the idea.
It's one of those books that you never hear anybody talk about. It was written in 2012 by a gentleman that worked for Soros, and then I believe Karsh Asset Management and DLJ, and now he runs his own fund. But it's really, I'm only a chapter into it, but it's really good. And it's one of those that has probably a 5-star and 5 reviews on Amazon, but it's almost 10 years old, and those are the ones I love to find. So far, it's been really good. So
cool. Thank you for the recommendation. That's up my alley.
Actually, Ian, I'm reading Phil Knight's book on one of your recommendations. I think it was on the club, or it's been on the bookshelf forever.
That microcap Nike. So.
Yeah, the microcap. Yeah, exactly. How to find the next microcap Nike. I'm sure there's some kind of shoe and what is it, NFT out there that we can maybe find at some point. But all right, well, with that, let's call it a day. I mean, everybody give, if possible, give an Ian-esque tweet of final thought here. Okay. Now, I don't know if everybody can do that, because Ian is quite prolific in his Ian-esque tweets. So your final thought plus where everybody can go and follow you on social. And I'm gonna let Ian go first. He can give his own Ian-esque tweet.
Yeah, I don't need to give a tweet, but something I actually was thinking about when I was thinking about everybody on this podcast right now was, I don't know what, I was reading an old article. It was an interview that John Daly did back in the late 1990s, and I don't know if everybody's familiar who John Daly is.
Rip it and rip it.
Yeah, exactly. He was grip it and rip it, and he kind of burst onto the golf scene in 1991. He was like the 8th alternate into the, I think, 1991 PGA Championship, which is one of the 4 majors in golf. And he kind of burst on the scene. Nobody heard about him. Probably one of the most, I don't know, like nobody thought he was going to win, and he ended up winning that tournament by 3 strokes. And part of his phenomenon was he just gripped it and ripped it. He was one of the first players ever to hit it over 300 yards. He was doing things in the golf course nobody's ever seen before.
Drinking and smoking.
Yeah,
exactly. Yeah, and he was drinking and smoking. And he kind of have his rally towel going down the 18th hole, and the crowd was going nuts. And he was just one of those people that there's a lot of him in each one of us. And unfortunately, he drank and smoked and gambled quite a bit, and he was overweight. But there's also this funny story. I think the following year in '92, him and Mark Calcavecchia were playing together, and they were playing awful. And there's 4 rounds in golf. They were playing awful through 3 rounds, and they both agreed they're gonna play the final round as quickly as they could. And they played the final round, I think, in just under 2 hours, and that's walking. And they actually got fined because the PGA Tour said it just wasn't professional, for them to do that. They both shot like 82s or something like that. They didn't care. But that's the type of character he was. But he always had this huge fanfare, nobody would fill a gallery like John Daly did, when he was winning, and he ended up winning another major in '95. But even, in '99 through the 2000s, when he was really awful, because he was really overweight, he wasn't really practicing anymore, but they'd still let him play. He still had just as big a gallery as Tiger Woods did. And Tiger Woods was, just a phenom. And I'm always interested in like how people build audiences and credibility and things like that. And I often think back to sort of this Tiger Woods, John Daly phenomenon, where it's like you either build your audience by looking like you're perfect or being perfect, or by being vulnerable. And people are kind of attracted to those 2 types of things. I think Bill's seeing some success on his podcast because, he's being who he is. He wears his emotions on his sleeve, and people like that because they see a piece of them and Bill. And I think I think the rest of you are like that. They're on here as well. And I don't know why. I was just thinking about that, and I read that. And anyway, I read this interview from Daly. I think it was done in 1999. So this is when he was still decent. And this is when Tiger Woods burst on the scene. And they actually were counting how many people were following John Daly versus Tiger. And more people were following John Daly, even though he was like 12 strokes back. And they asked him after the round, they said, so, why is it that you can still draw a huge gallery around you, even more so than Tiger Woods? It doesn't make any sense. And he just said, it was one of the greatest quotes I ever heard. He said something like, Tiger is incredible. He's perfect. He said, but I'm just a normal human being. He said, I gamble, I drink, I smoke, I'm overweight, I make mistakes. I'm not perfect. He said, when people see me win, they believe they can win too. And it was like probably the best quote I ever heard ever. But anyway, I have no idea what that relates to anything. I just thought I'd share that story.
That was great. And I like to, I've been trying to be the John Daly of MicroCap Podcast as much as possible. In fact, I think my producer gets so mad at me because I always say I love being the dumbest person in the room.
Well, so, I think, and the reason I brought that up, I think all of you guys have been really.
Hence the shelf.
I think all of you guys have been really successful. And I was thinking about it like, hey, listen, I'm not perfect. I'm sure as heck isn't. But I think a lot of you guys have been successful with Value After Hours, with Bobby and your thing, and Bill with your new podcast, just because you're vulnerable, you put yourselves out there, and that's what people are attracted to. So just keep crushing it. So.
Well, thank you, and please keep hiring bot farms to support us. We appreciate it.
It's getting expensive.
Oh, we need all the help we can get, Ian.
Thank you, Ian, man. I really appreciate that. Don't worry, Ian's coming out with a pod at some point in the next 10 years. I wish I could place my bet on that.
So I have one from, I think if I remember right, Bill, it was with your podcast with Adam Robinson. And I think he said that it was a story that Mario Andretti had told his son. And he said that the key to racing is you have to win the race as slowly as you can. And I thought, I had to sit there and think about it for a while. And I've been kind of internalizing it ever since I heard that. And like, God, that's right. I mean, I think it applies not just to investing, right? Like not taking stupid risks, not wadding yourself up in the corner on the final lap because you had to, win at a faster pace than everyone else, right? Like, but I think it applies in a lot of other places too in life. And it's really easy to get focused too much on trying to beat everyone else and to push past places where you probably should and then take shortcuts health wise. I mean, almost any asset or aspect of your life, it's really easy to try to take these shortcuts, which is another way of, kind of winning by going too fast. So I think there's a lot to be said for winning the race, but going as slow as you can and still winning. So that's my little thing.
That was a great one. That was a great part of that podcast too. That was good.
Absolutely. Toby, your final thought and or anecdote and or sports reference to investing.
I would say, I don't have any great ones off the top of my head, but I'd say that I think that small and microcap is an unusually good opportunity at the moment. I think it's there are very long cycles, and it's been through a very long down cycle. And it looks to me like it may have turned the corner. It's very early days. There have been a lot of head fakes. But if it has, in fact, turned the corner, then this is going to be a hot space for the next 5 or 10 years. And that's exciting. And so I'm looking forward to seeing it.
Very cool. And Bill?
I got nothing.
Very perfect.
I have nothing to add.
Good stuff, guys. All right. Well, with that, I'll let y'all go. Thank you so much for doing this. This was a lot of fun today. I'm sure we'll do a part 2 at some point, and there might be more books on here, and or maybe the shelf will be gone. We have no idea, but I really do appreciate it. And I'm sure I'll be talking to all you guys soon.
Thanks, Bobby. Thanks for having us.
Thank you.
Thank you.
Thanks, guys.